Welcome to vacationlord.com, your source for tools and tips for managing vacation rentals. In this video, we talk about how to file your tax return for your rental property when the property is owned by a company or LLC. This is different in the case where if you're just a regular property owner and you own the property in your own name, you might file under Form Schedule E. But under this scenario, you own a company that owns the property, and you are renting the property for profit. Now, a few other assumptions that we make in this video is that you are doing what is called material participation. Now, for the purposes of the IRS doesn't care whether you have your business in an LLC or whether you own it personally. The key thing in terms of filing your property as a business is your actual activity. You have to act like a business, not just simply own the property in a company. And material participation, what it means is you're conducting your activity as a real estate business and that you are managing it day to day, and you're managing all of the handling all the expenses, getting all the rentals, and you do it to such an extent that it looks like you are running a business. Now we'll get into more details as we get into the video, but that's the starting point for this. We also make a few other assumptions in this video. This is an introductory video. First off, we're assuming that you do not provide extra services, that your business is just renting the property. And secondly, we also assume that you own the property 100% and that you rent it 100% during the year. Let's get started. Before we get started in this video, I'd like to say a few words about what version of TurboTax you should use for your tax return. It gets down to what kind of business you have. Now, in this example, we are considering you're running a business with just rental income. And in the most basic case of that, the TurboTax Deluxe edition of the software is adequate for that purpose. Now, if you have a more complicated situation, you might want to upgrade to the TurboTax Business Edition. And that would be three general cases where that would be relevant for you. Number one is you have a business, a larger business, where rental income is only a subset of the income. So that's a more complicated case. And the other two cases are if you actually have employee payroll or you are paying many contractors with 1099s. If that's the case, then you're better off using the TurboTax Business Edition. Now, for this walkthrough, we're not going to go through those more complicated situations. We're going to consider the simplest case where none of those three situations apply. And if that's true, then the Deluxe software is perfectly adequate. So let's get started. So we're in our TurboTax screen. In order to get to the Schedule C, we want to go to Topic List and go down to Business Income Schedule C. Now, I've already entered a property here, or business income. It's already filled out. I'm going to walk through that. But I will mention one other thing. We also have an associated article and spreadsheet that will pre-summarize many of the numbers we're going to input in here. We're not going to go into that detail in this video. The detail is in that article and spreadsheet. And that's linked to below this video or article that you're referencing. So given that information is said, let's get started. So if you were adding business income, you would say add another business. Now what we're going to do here, I've already entered a business and I'm just going to walk through everything that I've done in it. So let's edit this. First thing is we enter the name. Now for our purposes, we're going to assume that this is your first tax return for your business. So the business started January 1st and you started it in 2020. And as mentioned previously, we assume you don't have any employees. and these other things don't apply. Just enter the basic information about your business here. Now again, this is asking, do you have an employer ID number? This would be relevant if you actually had employees on payroll. We're assuming not, so you would say no. And business codes. Now, if you actually had a business where you were selling inventory in addition to renting property, you would specify that here. But for our purposes, we select the code that's relevant for renting real estate, which is 531310 in this case. Which accounting method? Now, given that we're not a business, we don't have inventory, we don't do returns, we're going to select the cash method, which just simply says income and expenses that you occur during the year will be filed during the year that they occur. It's the simplest way of handling that. And here we get back to, do you play an active role in this business? Now, the correct terminology that we mentioned in the beginning of this video, this is called material participation. And you don't want to take this lightly, because what this means is you are really in the business of running real estate. It's not something you're doing on the side. Maybe you only work on it 1 hour, 5 hours a week, or you only have one property. You need to material participate. In this case, they say more than 500 hours, and you perform all the work. Now, this doesn't mean you can certainly hire people to do the work for you, but you need to be actively managing it, getting rentals, hiring contractors, and so forth. So don't take this lightly. And if you determine that you do not materially participate, you can file under what's called Schedule E. And on our website, we have videos that go into how to file on Schedule E if that applies. But in this video, we're assuming you're running it as a business, so we say yes. We're going to enter the business info manually here, just so you can get a good idea what's going on. Now, did you make any payments that require you to issue a Form 1099? Now, you could say yes or no here. Now, keep in mind that because we're using the deluxe version, this software cannot send out 1099s. You would have to file them on paper yourself. And actually, it's not that big of a task. We also have a video and an article that goes into how to do this on our website. If you have one or two of them, you could just file them manually yourself. Or if you feel more comfortable and you want to do them electronically, you can just upgrade to the business edition. So if you say yes here, you would have to file the forms manually, because the software will not provide the capability of doing that. So we're just going to say yes. Now, these are uncommon situations. You can read through these, see if they apply. Most likely they don't. Now, if you received a 1099 non-employment income, that's very unlikely. We're going to say no here. Now, in the next section, we're going to enter income. Now, income comes from two main places. One that is filed through a 1099 MISC, and income that is not filed in a 1099. Now, the 1099 would be relevant if there is some third party who got rentals on your behalf. They collected the rent, they charged commissions and so forth. They did all the paperwork for the money related to that. If that's the case, if there's enough business, they might send you a 1099. Now, the rules for that are pretty high. It's like something like $20,000 of income and 200 separate transactions. If you meet that threshold, then you may get a 1099. And if that's the case, you just simply enter it here for each one you get. We're just saying some realtor with a payer's employer ID, and then the key here is enter the rent. And most of these other things would not apply. but that's the basic information that would be found in that form, and you would enter it here. And you would enter it for each 1099 that you received. So let's move on. Now, if you have rental income from all the other sources, it could be some other marketplace. Maybe you didn't meet the threshold for 1099, or maybe you rented the property out and someone wrote you a check, or they sent you money in Venmo, or however it occurred. You would add up all that money and put it in income or sales here. Now these are not common for what we're doing here because we're just doing rental activity, so we don't have any goods to sell. And here's where we get into the details of calculating your expenses. And I'll just reiterate that what I mentioned previously, that it's helpful to summarize these expenses before you get to this screen. And we have a spreadsheet that helps you out in that regard. And then once you've summarized your expenses, it's just a matter of transferring them from that spreadsheet into the screens here. And we'll go into those details right now for each of these expenses. First one is car and vehicle expenses. Now, if you used a vehicle to travel to your rental property, or you traveled to pick up supplies, or you traveled to pick up any materials you needed to maintain the property, then that mileage could count against your vehicle deduction. Now we're going to consider the simplest case here. The simplest case is you're using your personal vehicle a small percentage of the time, and you want to claim the standard, like a standard deduction. It's the simplest case, and unless you have a lot of activity, and you may even have a vehicle that's used just for rental activity, if that's the case, then you might want to fully specify your expenses. But for most people, we're just going to say that you're just going to use some portion of your personal vehicle. So that's what we're going to go into here. So just simply specify, actually this is 2020 we put in the service. It's a truck under 6,000 pounds. You own the vehicle, we'll just say that. This vehicle was available for personal use, that's true. And you may or may not have another vehicle, that's possible. And you generally do want to track all of your mileage. It's good to document everything so that there's no question about the suitability of your deduction. So here are the important things. So we're going to enter some mileage numbers here, and you to adjust these based on your own use. We'll say we used our personal vehicle 12,000 miles a year. 1,000 miles was driven for business, and 7,000 miles were for other commuting miles. Now that 7,000, this commuting miles doesn't really play into the calculation, but it's just required to fill out the form. So adjust these numbers as you see fit. How many vehicles did you use? We're just assuming one in this case, so we'll say there. And like I say, we're going to stick with the standard mileage deduction. Now, if you have any of these other expenses, you can enter them here. It might be common you have parking fees or you're paying tolls. If you're traveling, when you travel to your property, you may pay tolls. You would enter them here. And you could enter, these might be less relevant depending upon where you live. So we haven't entered anything there, but just enter those if they apply to you. Okay, so there's our deduction for vehicle expenses. Next, we're going to move on to assets and depreciation. Now, when you first put a property into service and you're going to rent it out, you can depreciate the property. Not only can you depreciate the property, you can depreciate any physical good or structure that's used in the rental. That could be, it could be construction equipment. It could be all the furniture that you bought for the apartment or the home. Now, we're just going to consider the simplest case here. The first year you put your rental into service, you want to depreciate the property itself. So here we're just calling it a vacation home. So we're going to have one entry here just for the property itself. And the key point here is to understand that you're depreciating the value of the property, the physical property, and not the land. And we'll go into that detail you'll see that when we get into the detail here. So we're saying real estate property, we acquired it the first of the year. We're going to say it's real estate. And we're just going to call it the vacation home. And the basis is $500,000 and the cost of the land is $100,000. Now the basis, you need to be, you want to make sure you account for the basis for everything here that's relevant. The basis is not just what you paid for the property. It also includes many closing costs such as attorney fees, title insurance. We go into that detail there in the spreadsheet that accompanies this article that we mentioned before. It will give you a summarization of things that could potentially add to your basis because you want your basis to be as high as possible. Now the cost of the land, a general rule of thumb is land is approximately 20% the value of a property. This may or may not be true in your jurisdiction, but it's a good rule of thumb. You can also seek out a CPA or look at your property tax record for guidance on the value of your land. So we're going to say none of the above for these because this is just an existing property. And you want to say, yes, we're assuming that because you're running this as a business, the only thing you use this property for is business expenses and business income. So we're going to say yes 100% of the time. And we're going to enter this same date, the beginning of the year. So there's our depreciation expense. Now just to kind of mention a little bit more about that. What depreciation is, this is the estimate of the loss in value of your rental property each year. And this is on in this case, it's on a 39-year schedule. So if you buy the property, that structure is estimated to lose $9,000 of value every year for 39 years. And that actually, you may think, well, that doesn't make sense. But actually, though, your property does depreciate in value in the sense that over a given 20 or 25 year time frame, you typically would need to renovate your property, add new siding, add new appliances, and so forth. So this, in a sense, is somewhat accurate to account for that. Okay, so we're going to just stick with that for the moment. So let's go to all other expenses. Now this is a very nice, neat form here. And I filled in examples here of expenses that are most common that you may actually encounter or account for. Now, it's possible you have other ones here, but these are typically not relevant unless you're running other kinds of business besides rental income. So we just go through here: advertising, commissions, business insurance. This would be property insurance, legal professional fees. Maybe you paid a lawyer to do a title search, interest on a mortgage. This on a first mortgage, this would also include points if you had points. Repairs and maintenance. This may not be entirely clear, but maintenance would include cleaning fees. So if you clean your property, say you're renting your property on a weekly basis and you have cleaning fees, you want to make sure you include that here as well as repairs. Supplies, that's pretty self-explanatory. Taxes and license. This would include property taxes and any sales use taxes you pay on rentals. And the last one is utilities, which is pretty self-explanatory. Okay, no, this is not really relevant. Now, there are other business expenses that you may not that may not be accounted for in those other categories or the previous categories. So we could put them here. I just entered a few here that might be relevant. Association fees, like you have condo association fees, you could put that here. Mortgage interest at closing, we're calling that $1,000. Now it's possible, what you want to make sure is we entered mortgage interest previously, and you want to make sure that that number matches what was on your 1098 form. And if there was additional interest, say at closing, that was not accounted for, you could enter that here separately. And here we can enter a description that says mortgage interest at closing, so it's clear that you're claiming more interest than what the bank reported, so that there's no confusion as to why that happened. Next, we have these other situations. These are generally really not relevant. The key thing here is I have money invested that I'm not at risk at losing. We're assuming that you purchased this property with your own money. You borrowed the money under your name or your company's name. And under most situations, that's true. So we're not going to consider any of these situations here. Next, the last thing we need to consider is home office expenses. Now, if you have enough activity where you're doing paperwork, or maybe you're on your computer managing rentals, bookings, and so forth, calling contractors, you generally say you want to do that in your office. You have a separate room that has its own entrance and has a desk and a chair. Then by all means, set it up as an office if you actually do conduct your business. So we're going to go through that just in case that applies to you. So we're just going to specify the name of the office. I own the home, and you do all of your business from this home. Well, that's typically true, right? You would do all of your paperwork wherever you live. That's not an uncommon thing. And here you just need to specify the square footage. Here we're just going to say your room in your house is 200 square feet, and the entire house is 3,000 square feet. Now, we're going to use what's called the simplified method, and the simplified method for a home office can work to home offices of up to 300 square feet. So here we've entered 200, so that would apply. So we're going to say we first use it at the beginning of the year, and we'd say, well, we only used it maybe 6 months out of the year. You can adjust this number as necessary. Now, of course, you want to say the percentage of time you spend conducting business in the home office. So the reason why you want to say 100% here, because you're using that office for your business. Now, this might not be true. Let's say you use the office for your rental income, and your wife uses the office for some other business activity, where that business may be claiming a deduction. If that's the case, then you might want to say 50%. Say, I'm only using it 50% of the time, and my spouse is using it the other 50%. But under most circumstances, you want to say 100% here. So we're going to say take the simplified deduction. Now, if you have a lot of business and you're doing and you have a lot of you're spending you're a full-time business in here and you have a lot of expenses, then you could do actual expenses. But again, we're considering this to be a simpler case. We're considering the simplest case where your home office is you're only using it a certain percentage of the time. So we'll just take the simplified deduction. There we are. Deduction is $500. Okay, so we've entered all of our expenses. Now the last thing is what's called qualified business income. Now, because you're running your rental activity as a business, we assume that you're in it to make a profit. And if you do actually make a profit, it's possible that you can qualify for what's called the qualified business income. And what that will allow you to do is 20% of your income will be excluded from your taxable income. And the test for this is very similar to the material participation test. So you have to be in this running it as a business. And it has to be, you could say, your main business. So if your main income and you're spending at least 500 hours a year, and you're running your rental activity, and it's a major part of your day, and you're spending a lot of time on it, and you're managing it yourself. If that's true, and you've already indicated that your material is participating in your rental activity, then you can say, yes, this is qualified business income. Here, we're not going to, these are uncommon situations. We're going to say no to these. Now, here's where you get into the details of are you able to actually claim the deductions. Now, specified service include professional services performed in any of the following fields. Now, this goes into the details of how this deduction is. Now, under our scenario, we're just renting real estate. None of this really applies. So we're going to say no. We don't receive any income from these kinds of services because we're just renting real estate. This is business with common ownership. That's not common, so we're going to say no. So here we are. So the qualified business income for your rental property is $18,000. And that 20% exclusion works out to a deduction of $2,600. And there you go. So there's a summary. So everything we've entered here, we had an income of $73,000 and we have net income of $18,000. Let's go to the forms to see how it all worked out and see if it makes sense. So here's our form. Okay. So we have $50,000 here, $23,000 total income. Let's go down here. See, all of our expenses showed up. Looks like these look good. Repairs, maintenance. Total expenses. Here's our home office deduction. And there you go. Everything looks good. So there you have it. So let's go back to our main screen here. So that's how you enter your business income using Schedule C for rental income. Now, I would reiterate, this is a very simple case. This could easily get more complicated depending upon how much activity you have and whether you have employees, and then your paying contractors. Now, so we've covered the most simplest case here, where we're taking each case we're taking standard deductions or using simplified method to calculate expenses. So this is a good starting point. And if you have any questions, maybe that apply in your situation that are different than what we covered here, let us know. You can enter comments below this video or article, and you can reach out to us on our website, vacationlore.com, and we'd be more than happy to help you. Thanks for watching.